When it comes to choosing a mortgage, one of the most significant decisions homeowners face is whether to opt for a fixed-rate mortgage or an adjustable-rate mortgage. While fixed-rate mortgages offer the comfort of predictability with a consistent interest rate throughout the loan term, adjustable-rate mortgages provide flexibility that can be appealing, particularly for those who have specific financial goals or plans for short-term homeownership. Before diving into whether or not an adjustable-rate mortgage is a good idea, teaser, it usually is not. It's crucial to understand its structure, benefits, risks, and whether it aligns with your long-term financial strategy. Check out the full details by visiting the link in the description. Why listen to Dad's fire talk about mortgages? I was a mortgage broker early in my career, so I have personal experience with the entire mortgage origination lifecycle. I am a chartered financial analyst. I've also had dozens of mortgages over the years. I've had adjustable mortgages, balloons, fixed rate, interest only, and so forth. What is an adjustable rate mortgage? An adjustable rate mortgage is a home loan where the interest rate can change periodically based on fluctuations in a specific financial index, such as the LIBOR, London Interbank Offered Rate, the U.S. Treasury Index, or the Secured Overnight Financing Rate, SOFR. Typically, adjustable-rate mortgages start with a lower interest rate compared to fixed-rate mortgages, making them attractive to borrowers looking to reduce their initial monthly payments. This lower rate is only temporary, as the interest rate will adjust after an initial fixed period, which can lead to higher payments over time. The structure of an adjustable-rate mortgage is often denoted by terms such as 3/1, 5/1, 7/1, or 10/1. These numbers represent the initial fixed-rate period, followed by how frequently the rate will adjust. For example, in a 5/1 adjustable-rate mortgage, the interest rate is fixed for the first 5 years, after which it adjusts annually based on the chosen index. This structure provides borrowers with lower rates initially, but it also introduces the risk of higher payments in the future if interest rates increase. The role of interest rate caps in adjustable-rate mortgages. Interest rate caps, also known as interest rate ceilings, are a crucial feature of adjustable-rate mortgages that limit how much the interest rate can increase or decrease during the loan term. These caps are designed to protect borrowers from sudden and significant increases in their mortgage payments, offering a degree of predictability in an otherwise variable loan. There are typically 3 types of caps associated with adjustable-rate mortgages. Initial adjustment cap. This cap limits how much the interest rate can change the first time it adjusts after the fixed period ends. For instance, if you have a 5/1 adjustable rate mortgage with an initial adjustment cap of 2% and your initial rate is 3%, the rate could go up to 5% in the first adjustment period. Subsequent adjustment cap. This cap limits how much the interest rate can change during each subsequent adjustment period. If your adjustable rate mortgage has a 2% cap on subsequent adjustments, your rate could increase by up to 2% each year after the initial adjustment. Lifetime cap. This cap limits how much the interest rate can increase over the life of the loan. For example, if your adjustable rate mortgage has a 5% lifetime cap and your initial rate is 3%, the maximum rate you could ever pay would be 8%. Lenders determine the interest rate caps based on several factors, including the borrower's credit score, overall financial health, current interest rates in the market, and the lender's guidelines for assessing the risk associated with the loan. The benefits of an adjustable rate mortgage. There are several reasons why borrowers might opt for an adjustable rate mortgage over a fixed rate mortgage. One of the primary advantages is the lower initial interest rate, which can result in significantly lower monthly payments during the early years of the loan. This can free up cash flow for other expenses, investments, or savings. If you plan to sell your home or refinance before the fixed period ends, you can take advantage of the lower rates without ever facing a rate adjustment. Another potential benefit is the flexibility an adjustable rate mortgage offers. For instance, if you expect your income to increase in the near future, the lower initial payments can provide you with breathing room until your financial situation improves. If you're purchasing a home during a period of high interest rates, an adjustable rate mortgage allows you to start with lower payments with the expectation that rates may decrease in the future. Understanding the break-even point. A critical concept for anyone considering an adjustable rate mortgage is the break-even point. This refers to the time at which the savings from the lower initial interest rate are outweighed by the higher payments that result from rate adjustments. To determine whether an adjustable rate mortgage is a good deal, you need to calculate how long you plan to stay in the home and compare this with when the rate adjustments will begin. For example, if you opt for a 5/1 adjustable rate mortgage and plan to stay in the home for only 3 years, you may never experience a rate adjustment, making the adjustable rate mortgage a cost-effective choice. If you stay longer than the initial fixed period, you risk facing higher interest rates, which could negate the savings you enjoyed during the initial years. The reality of homeownership. How long do people stay in their homes? On average, homeowners in the United States stay in their homes for about 8 to 13 years. This statistic is essential when considering an adjustable rate mortgage, as it directly impacts whether the loan structure will benefit you in the long term. If you plan to move within the initial fixed period of an adjustable rate mortgage, the lower interest rates can be advantageous. If your plans change and you end up staying in the home longer, you could face rate adjustments that increase your payments. Before we continue with the video, take a quick moment to hit that like button and subscribe if you haven't yet. And don't forget to ring the bell for notifications so you never miss out on our latest updates. Plus, we've got some helpful resources in the description. Check them out and share your comments after you're done watching. The risks of adjustable rate mortgages. While adjustable rate mortgages offer potential savings and flexibility, they also come with significant risks that borrowers must carefully consider. One of the most substantial risks is the uncertainty surrounding future interest rates. If interest rates rise significantly after the initial fixed period, your mortgage payments could increase substantially, straining your finances. Another risk is the potential for negative amortization, which occurs when your monthly payments are not large enough to cover the interest due. In this scenario, the unpaid interest is added to the principal balance of the loan, increasing the amount you owe over time. This can happen with adjustable rate mortgages that have payment caps but no interest rate caps, leading to a situation where your loan balance grows even as you make payments. Balloon payments present another risk with some adjustable rate mortgages. A balloon payment is a large, lump sum payment due at the end of the loan term, which can be a financial burden if you're not prepared. If you cannot pay the balloon amount, you may need to refinance or sell your home, both of which can be challenging depending on the market conditions and your financial situation at the time. The stability of fixed-rate mortgages. In contrast to adjustable rate mortgages, fixed-rate mortgages offer stability and predictability. With a fixed-rate mortgage, your interest rate remains the same throughout the loan term, ensuring that your monthly payments do not change. This stability can provide peace of mind, especially for borrowers who plan to stay in their homes for an extended period or who are risk-averse. Fixed-rate mortgages are often considered the safer option, particularly in environments where interest rates are low and likely to rise in the future. While the initial interest rate on a fixed-rate mortgage may be higher than that of an adjustable rate mortgage, the predictability of payments can be worth the extra cost for many borrowers. Lessons from the mortgage industry. Avoiding common pitfalls. As someone who worked as a mortgage broker before 2008, I saw firsthand the consequences of borrowers choosing adjustable rate mortgages without fully understanding the risks. One of the most significant flaws I observed was the practice of approving borrowers based on the lower initial rate of an adjustable rate mortgage, without considering the potential rate increases. Many Americans, eager to purchase larger homes, were approved based on the teaser rate, leading to financial distress when the rates adjusted and they could no longer afford the payments. This experience highlighted the importance of underwriting mortgages based on the highest possible rate, rather than the initial lower rate. Homebuyers should avoid making decisions based solely on what they can afford at the introductory rate, as this can lead to difficulties if the rates rise significantly. It's crucial to consider the worst-case scenario and ensure that you can still afford the payments if the rate reaches its cap. Who is an adjustable rate mortgage appropriate for? Adjustable rate mortgages can be an excellent option for certain borrowers, particularly those who have a clear plan for their homeownership timeline and are comfortable with the potential risks. If you plan to move or refinance before the rate adjusts, an adjustable rate mortgage can save you money by providing lower initial payments. If you expect a significant increase in your income or financial situation, an adjustable rate mortgage may offer the flexibility you need. Adjustable rate mortgages are not suitable for everyone. If you're uncertain about how long you'll stay in your home, or if you prefer the stability of predictable payments, a fixed rate mortgage may be a better choice. Assessing your financial situation, future plans, and risk tolerance is essential before deciding on an adjustable rate mortgage. So, is an adjustable rate mortgage right for you? Ultimately, whether an adjustable rate mortgage is a good idea depends on your financial goals, risk tolerance, and how long you plan to stay in your home. While adjustable rate mortgages offer the potential for lower initial costs, they come with risks that must be carefully weighed. Never make a decision based solely on what you can afford at the lower initial rate, and always consider the worst-case scenario where rates rise to the cap. If you're considering an adjustable rate mortgage, make sure to thoroughly review the terms, understand the caps, and calculate the break-even point to determine if this type of mortgage aligns with your long-term plans. For some, the flexibility and potential savings of an adjustable rate mortgage make it a smart choice. For others, the stability of a fixed rate mortgage may provide the peace of mind that's worth the extra cost. Regardless of your choice, being well-informed and realistic about your financial capabilities will help you make the best decision for your unique situation. Thanks for watching, and if you found this video helpful, don't forget to like, subscribe, and share it with your friends. Also, don't forget the link in the description.